let's run a small social experiment real quick to set the stage for tokenomics later. All right, so we have two friends, Bonnie and Rick. Now, Bonnie here knows a thing or two about crypto and holds some assets, while Rick doesn't really pay much attention to the space. We show both of them Ethereum's coin page on CoinGecko. How do you think each of them will interpret the information on the page? Since Rick doesn't really know much about crypto, the coin's price will probably be the only thing that will grab his attention and make sense to him, right? On the other hand, Bonnie may pay more attention to other details like the market cap, circulating supply, maximum supply, etc. Basically, in doing so, Bonnie is sort of assessing Ethereum's tokenomics. So in this video, we will find out what tokenomics is and what it entails. But before that, we have a special announcement of a brand new feature on our platform. So we have introduced a tokenomics tab that analyzes token allocation, supply schedule, vesting, and mechanics that will not only help you in your crypto research, but also save you a lot of time. So do not miss out. Make sure to check out the new feature on our website. All right, let's get to it. What is tokenomics? So the term is used to capture a token's economics. Building a crypto project can be analogized to building a car from the ground up. And tokenomics is one of the most important parts of the car. Now, if you only look at the price of a token, so say a brand of a car, you're not really getting a whole lot, right? You know, oh, it's a nice car. But you also want to look at how the car will move, how efficiently it will do so, and how far it will go. So tokenomics of a token includes, but is not limited to, its functionality, objective, allocation policy, and emissions schedule. So let's check out some of the key elements of a token's tokenomics, starting with the token supply. So unlike physical goods, supply in crypto is not as straightforward. Earlier in the video, when we were checking out Ethereum's coin page, you may have noticed three types of market supplies displayed. That is the total supply, circulating supply, and maximum supply. So the circulating supply is the number of publicly issued tokens in circulation. Currently, there are over 120 million Ethereum coins in circulation. This is an indicator that Ether is actively being mined. The total supply, on the other hand, also includes any tokens that have been created and then burned. So burning in crypto is used to describe the act of permanently removing tokens from circulation, making the remaining tokens in circulation becoming more scarce. Lastly, the maximum supply is the maximum number of tokens that can ever be generated. However, not all projects have this. For instance, Ethereum has no maximum limit, although its issuance each year is capped. Bitcoin's tokenomics, on the other hand, dictates that no more than 21 million coins can ever be mined. We have also seen NFT projects taking scarcity to the extreme. Projects like the Bored Ape Yacht Club only have 10,000 NFTs in their collection, while some projects might mint only a single NFT for a piece of art. Another key metric of a token's tokenomics is market capitalization, commonly known as the market cap. It describes the sum of total funds invested in the project and is calculated by multiplying the current market price of the token by the circulating supply. This is one of the common ways of ranking coins by size and popularity, since coins with higher market caps are seen as more popular. Oftentimes, sophisticated investors will make use of the circulating supply and market cap data to estimate and project the token's value, especially when combined with other parameters such as vesting schedule. A token with high market cap but low circulating supply, for instance, can be subject to high selling pressure in the future, especially when there are aggressive vesting schedules lined up. On the other end of the market cap spectrum is the fully diluted market cap, which is the measure of the market cap when all the coins are issued. It is calculated by multiplying the sum of the maximum supply of a coin by the coin's current price. Fully diluted valuation is another metric that investors use to measure a project's value. When you see the term valuation in an article about raises for a crypto project, it refers to FDV. Now, we recently added a fully diluted valuation toggle and coin comparison page to allow you to seamlessly compare market cap and fully diluted valuation between different cryptocurrencies. Another variable that affects tokenomics is the allocation and distribution of tokens. During the initial launch stages of a project, the executive team or the community will decide how tokens are allocated or distributed. Generally, there are 4 main categories of initial asset allocation. The first allocation category is the public sale, which is open to anyone who wants to participate. Then, community allocations are ecosystem funding that goes back to the community. The third allocation category involves insiders. These are the people who have a vested interest in the success of the company. In return, they receive a lot of the company's share. Then fourth, other tokens may be allocated to foundations, grant pools, and other rewards that are given out to the people who participated in the community. Token allocation and distribution are essential in assessing a project's tokenomics. For example, if a project's tokens are primarily owned by its founders, they will have significant control over the project's governance and could make decisions that are not in the best interest of the network as a whole. This could lead to stagnation or even worse, a complete collapse of the project. Closely related to the allocation metric is vesting. This refers to the process of locking and releasing tokens after a particular period. Sometimes, if too many tokens are circulated in a short period of time and releases are made too often, the chances of its value depreciating is high. Usually, vested tokens are offered to advisors, partners, team members, and other key members to align common interests and long-term commitment to the project. Next up, we have one of the most important aspects of a token, its utility. Use cases for tokens can vary. For instance, governance tokens allow the holder to vote on changes to a token's protocol. Stablecoins, on the other hand, are designed to be used as a currency, while security tokens may represent different financial assets on the blockchain. So, in other words, what problems does the token solve? To sum up, since Bitcoin was created in 2009, tokenomics has evolved significantly, but overall, most projects with solid tokenomics models have stood the test of time, while some with poor tokenomics designs have faltered. That said, it's important to note that no single factor provides a magical key to a project's success. It's always a good idea to combine tokenomics analysis with other tools when assessing a project. So let us know in the comments about other tokenomic metrics that you consider before investing in a project. And of course, also remember to like, subscribe, and follow us on all our socials for future alpha. See ya.